Good morning. Thank you, Vanna. Sorry I'm a few minutes late. I'd like to call the November 15th meeting of the Investment Advisory Committee to order. I'd like to welcome all the IAC members, IMD staff, and guests who are visiting us on site and online. If you'll stand and join us for our Pledge of Allegiance, and then we'll do our salute to North Carolina flag. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina and pledge to the old North State love, loyalty, and faith. Thank you, members. As we adjourn this meeting, I'd like to do it in honor of former Winstonian and Controller of North Carolina, Dr. Linda Combs, who passed away weeks ago. If you've not ever heard her name, then that's an example of the public servants that we have working for the state of North Carolina. You don't know their names, you just know that they do a great job. But to give you a little bit of history, we have had 75 governors, we've had 28 treasurers, but only 8 controllers in the history of North Carolina. She was the first female controller of our state. In addition to that, she was the chief fiscal officer for the United States of America, and to my knowledge, the only person who went through 3 confirmation processes in the United States Congress and 1 in the North Carolina General Assembly and never received a no vote. Wow. Before she left office a year and a half ago, she was responsible for upgrading our computer system, which Robin and our people at FOD are dealing with right now, consolidation and the upgrading of our computer system. And there's always hiccups when you have an upgrade of a computer system of a state this size. But generally speaking, it was done under budget, within schedule, and she will be missed. And I was honored to be her pallbearer in Winston-Salem a few weeks ago, and after hearing her eulogized, I think she really missed her calling. She should have probably been an NHL referee, because she had a real track record of taking men, typically, who play NHL, and getting them to calm down and sit down and figure out how to actually solve problems. So we'll miss her in Winston-Salem. We'll miss her across the state of North Carolina. That's Dr. Linda Combs, if you'd like to look up her resume at Journal Now. With that, I'll turn the meeting over to Legal Counsel Ben Garner to call the roll, verify quorum, and to relay any housekeeping matters you need to be aware of.
Morning, Ben Garner, General Counsel for the department. So I'll take a roll for the committee members. First, Mr. John Anarella.
Here.
Mr. Brewer.
Good morning.
Good morning. Mr. Coakley.
Here.
Mr. Mevin. Mr. Patterson.
Present. Here.
Treasurer Full.
Good.
All right, we have a quorum.
Is that 100% attendance?
Yes, sir.
Good job.
All right. I'll do a few quick reminders. Mr. Brewer, you're the only one calling in, so just please remember to mute your phone when you're not speaking. And if you need to leave the meeting, let us know. And when you rejoin, please identify yourself. All the votes we'll do, it's just a couple, as you know, we'll do by a roll call, and we'll deem the members who make the motion or second it as voting yes. Today's meeting agenda is posted for public availability on the Department of State Treasurer's website, www.nctreasurer.com, at the Investment Management Division page. If we lose connection, which it's unlikely, but if we do, the meeting will be deemed in recess. We'll put a notice on our website, and then with information about when we'll resume the meeting. If there are no questions, then we'll continue.
Okay. Today's agenda has been posted online, is available for public viewing. We've already been told about the meeting procedures. Are there any questions regarding the meeting procedures? Hearing none at this time, I'd like to turn the meeting over to.
Let's approve the minutes. I'm sorry.
Move approval of the minutes. Second.
All right.
No further discussion. Hearing none, the clerk will call the roll.
All right, Mr. Anarella?
Yes.
All right, Mr. Brewer?
Aye.
Mr. Mevin, you seconded. Mr. Treasurer Falwell?
Aye.
All right.
Thank you. Sorry, I chair a lot of meetings in this room, and they all have a different pattern to them. So, thank you. Now we'll call on Jeff and Smith and Christopher Morris, who are co-CIOs. And before they take the floor, I've spoken to both of them. Everybody knows this is my last term as the state treasurer in North Carolina, and I appreciate their commitment to continue to fill their responsibilities and duties until the end of my term, and hopefully even beyond that. So thank you very much. I also want to tell the members of this IAC committee that some of you may occasionally see Pensions Investment Magazine. We see it every week, and you should, if you ever took a moment and to sit back to ingest the amount of turnover that exists in these large pension plans at this level, you would be shocked. And every time that there's turnover, a new CIO comes in and says, I don't like you folks, so I'm going to go hire these folks. I don't like those investments, I'm going to go get these investments. Every time that happens, it just creates a lot of uncertainty and churn in these pension plans. So I'll say this over the next year, but I just want to thank Jeff and Chris Morris for stepping up to the plate. They're a great tag team. One's a little better barbecuer than the other one. But which one?
It shows off in our belt size too. So.
But I just want to thank you because your influence, not only as employers of people, as supervisors, and as co-chief investment officers, as the people who teach, protect, and serve are the beneficiaries of this stability. So if you could top that, you have the floor.
Well, thank you. It's an honor to serve in the role that we do, and so we appreciate those words. Move on to talk a little bit about the third quarter and kind of look a few highlights, and I won't hit too much on fixed income since we're on the agenda as well later on. We'll talk a little more in depth there, but entering the second half of the year, there was expectations the Fed would be pivoting to lower rates. We ended the quarter a lot different, talk about higher for longer, so definitely a big contrast from the beginning to the end of the third quarter. The Fed continued to tighten. We had another 25 basis points hike in July and signaled that more hikes were possible as well. And then the September meeting, we saw updated projections that we'll discuss a little bit later in the fixed presentation. After a strong first half of the year, equities were weaker as the revised dot plot from the Fed showed sustaining higher rates, and the soft landing for the economy was a little more uncertain. Unlike the first half of the year, the Magnificent Seven stocks performed weaker than the rest of the S&P 500. On the energy side, we saw stronger energy prices, really on the backs of surging higher on production cuts that we saw from Russia and Saudi Arabia. On housing a little bit, has definitely been materially impacted by the higher mortgage rates, existing home sales hitting their lowest level in a decade. I saw one stat which had the median home value in the U.S. roughly versus 3 years ago, you're paying that monthly for that is $900 more than it was just 3 years ago, based on that hike in rates. So it has to be a material change in the pockets of those folks. Globally, there continued to be notable weakness in China, with the demand for goods from developed markets declining further for them. Chinese exports to the U.S. have fallen almost 9% over last year. And in addition to the issues they're having there, also we've heard stories about the real estate market they're experiencing there, challenges with their biggest developers. So a little bit of oversight on the quarter, and I'll turn it over to Chris, and then we'll touch on the fixed income stuff a little more depth later on.
Now, did all that change yesterday?
That quick. It's funny. We'll talk about, I've got some verbal updates to some of the charts, because when we put it together, numbers are a little different.
Good morning, everybody. Turning over to the portfolio on slide 7. Total assets under management for the investments division was at $173.2 billion as of the end of Q3. That's down about $2.4 billion for the quarter, but up about $8.3 billion for the calendar year. The majority of the quarterly decrease was due to the depreciation of NCRS assets as both public equities and fixed income markets struggled in Q3. NCRS was down about $3.3 billion for the quarter, but it's still up about $2.5 billion for the calendar year. The cash management program was up about $1.4 billion for the quarter and up close to $5 billion for the year. Then the supplemental retirement program, as well as our ancillary funds that we manage, those were both down slightly for the quarter. But like I said, as consistent with the other assets, they were up pretty significantly still for the calendar year. Moving over to slide 8. This is a snapshot of the asset allocation for the NCRS portfolio as of September 30. Portfolio ended the quarter at $111.8 billion, down from just north of $115 billion at the end of Q2. No major changes in portfolio positioning for the quarter. We continue to be underweight growth by about 5%, as all of those asset classes are currently underweight the long-term target. Rates and liquidity continues to be overweight, currently at about 4.5%, with the entire overweight being driven by the pension cash asset class. You will see that we talked about last time how we were reducing our underweight to IG fixed income and moving some money from cash to IG fixed income. We continued to do that in Q3, and you can see here we're right at our long-term target for IG fixed income. So we have reduced that underweight and are sitting at neutral to our long-term target. So it's kind of where we felt comfortable, and I think we'll probably hold steady here for a little while in terms of that asset class. The inflation-sensitive and diversified portfolio is just under target with an underweight to inflation-sensitive and a slight overweight to core real estate. And then our multi-strategy portfolio continues to be modestly overweight at about 1%. Moving on to the next slide, just give us a more recent snapshot, which was as of November 6th. It has changed a bit since then, given the continued rally in both equity and bond markets since a little over a week ago. We've seen higher volatility this quarter. Both equity and fixed income markets were down more than 2% in October, but as I just mentioned, that rallied significantly in November. Total market value as of November 6th was roughly consistent with where we ended the quarter at just over 111 billion. Slightly north of that now. I think we're over 112 billion now through yesterday, as markets continue to rally. No major changes since quarter end in terms of asset allocation. Slightly less overweight growth and slightly less underweight growth and slightly less overweight rates and liquidity as markets moved, but nothing significant from that perspective. Moving on to slide 10, the returns for NCRS versus our benchmarks. Portfolio was down 2.4% for the quarter. As I mentioned before, both equity and bond markets struggled for Q3. For the 1 year, the portfolio was up more than 7.2%, driven by very strong equity markets for that time period. 3 and 5 year time period were up 3 and 4% respectively, and longer term time periods faring slightly better than that at being close to or above 6%. Relative performance for the quarter was ahead of both benchmarks, with the 1 year time period lagging both benchmarks. Longer time periods are still consistently exceeding both our implementation benchmark and our long-term policy benchmark. Taking a look at Q4, as I mentioned, volatility, down markets in October, strong rally in November. Portfolio is up probably close to about 1% overall in Q4, and calendar year to date sits at slightly more than 4% up for the calendar year through mid-November. Slide 11 shows our growth of a dollar chart. Again, no major changes here quarter to quarter. This chart shows really since inception of our mark-to-market in 1997 how the portfolio has grown. So the orange line being the pension fund, the blue line being our implementation benchmark, and the yellow line being our long-term policy benchmark. And it's tough to see, but the orange line is ahead of both those benchmarks for this long time period, which is what we aim to do. On slide 12, same type of chart, just two different time periods for the 5 years and 10 years ending Q3. You can see that for these time periods as well, that the pension fund is exceeding the long-term policy benchmark. And you can see we've added in the alternatives asset class, so you can see how that has affected the total plan, or if it's adding value or not. You can see that that green line is above both the pension fund and the long-term policy benchmark for both the 5 and 10 years. So you can see that that is additive to the portfolio as a whole. Moving on to slide 13, if there's no questions on any of that. This shows our contribution to total plan return for the 1 year time period ending September 30. So you can see on the right side is in percentages, the 7.2% 1 year annualized return. And on the left side is that converted into earnings. So you can see the 7.2% return equates to about $7.8 billion in earnings for the year. And you can see below that what the drivers are. And pretty evident there that the driver of pretty much all of that has been the strong public equity markets for that 1 year. Public equity was up just north of 20% for the 1 year ending Q3, and that drove pretty much all of that 7.2% return and 7.8% or 7.8 billion in earnings.
Chris, is there any significance to the IG fixed income being in red?
No, I think that probably should just be in black. I think it was just a formatting thing with the slide. So
Right, no worries. Thank you.
yeah, the red should be just on the negative side. But so moving on to the next slide, this is the attribution versus our implementation benchmark for 1 year. You can see that the portfolio underperformed by about 1.3% versus our implementation benchmark. On the top right, you can see kind of the drivers of that, both allocation effect, which again is how we're positioned versus our long-term policy targets. And then the selection effect is how each asset class performed versus their individual benchmarks. So you can see it was negative for both of those, with the allocation effect driving the majority of that. Again, with equity markets so strong for that time period, the underweight to equity had a negative impact for that. So that was the largest driver of the underperformance there. And on the next slide, you can see the 3 year time period. Similar story here, slight underperformance by about 0.5%, and again, driven by the allocation effect, where selection effect was slightly positive. And then on the 5 year, on the next slide, similar story there, just a slight underperformance, pretty close to the benchmark, about 20 basis point of an underperformance there. But we did see that selection effect is still very strong for that longer time period, which is something we like to see. And allocation effect is negative, driving the underperformance at the total level. If there's no questions there, I'll move on to slide 17. This shows our risk metrics for several different risk metrics that we take a look at. If you take a look at the top left, you can see the rolling volatility of the portfolio. It's something I've talked about a little bit in the past, and you can see the blue line there, which is the 1 year moving average of the volatility of the returns of the portfolio. You can see that came down pretty sharply this year after peaking right kind of at the end of 2022. If you look at the orange and the gray line there, you can see that's really spiked up pretty significantly over the last several years. And I mentioned it in previous meetings that, we seem to be entering into kind of a whole new regime of higher volatility And we see that blue line jumping around a lot more than we did in really in the last decade, in the 2010s, where that number was pretty much below the long-term average. And you can see it there on the chart where it was extremely low volatility. And then once 2020 hit, COVID hit, and we've had a number of sort of volatility spikes in certain environments, and you can see that number's jumping around a bit. And as I mentioned, Q4, you'll likely see that pop up a bit again, given October was significantly down, and we've seen a significant rally in November as well. So we are seeing higher volatility on the whole, which leads to not only higher volatility for the returns of the portfolio, but it leads to higher volatility in our tracking error when we deviate from what our benchmark targets are, which you kind of see in the top right there. Moving on to slide 18. Won't spend a lot of time here. This is more risk metrics that we take a look at, the up and down capture of how the portfolio reacts in certain environments. And then on the bottom, you see there the drawdown and how the pension fund has performed versus several of our benchmarks. I'll just point out, if you look at the bottom right there, you can really see how prolonged this downturn has been since really the end of 21. And that, 22 was a really rough year. We've seen a material improvement since then, but we still see a lot of volatility, and we haven't even gotten back to, to level from the drawdown that we saw really throughout 2022. So you see that it's pretty prolonged compared to some of these other drawdowns that we've seen over the last decade or so, where you saw drawdown and then a pretty quick recovery. We haven't even gotten back to really zero from the drawdown that we saw really throughout 2022. Moving on to slide 19, shows our universe comparison versus similar public pension fund peers. No material changes here from previous meetings. Again, we have a more conservative asset allocation than a lot of our peers. We typically lag in bull markets, but protect better on down markets. You can see kind of the percentile rank on the returns are below median, but our risk is generally way below median, and in certain time periods you can see like the 5 and 10 there, we're really in the bottom decile in terms of risk, which means we take the lowest risk versus a lot of our peers. Slide 20 shows the Sharpe ratio, which is really a combination of the risk and return. And over the long term, we usually fare fairly well there, given our low risk profile. And you can kind of see that in kind of the 10 and 15 year numbers. Slide 21, this is a new slide I put in here. For this, we talk about the universe comparison and kind of how we're conservative versus our peers. This is kind of one of the reasons why, and I wanted to kind of show the other side of that. Is like, okay, why do we take less risk than our peers? The reason is this slide here. This slide shows the funded status of all of the 50 U.S. public funds of all of the states and kind of how we sit. So NCRS is at 87% funded. This data is a couple years old. It's a little different now, but the funded status doesn't change dramatically from year to year. So as of 2020, we sat at 87% funded, where the median of U.S. pension funds was at 71%. And we sat in the top quartile of that at the 14th percentile. So there's only a handful of funds that have a better funded status than we do, which, doesn't force us to reach for return by taking more risk, which some other plans have to do, right? So it's one of the reasons why we have a more conservative profile, and there's a number of reasons for that. I mean, one of them is, we've been fortunate that the General Assembly has funded the required contribution set by the actuaries pretty much every single year since the inception of this plan. And by doing that, it allows us to take a more conservative, asset allocation profile where we don't have to take a lot of risk and potentially risk very large drawdowns, right? So this is obviously a very important slide in terms of the health of the plan, and it's one of the main things we take into consideration as we develop our asset allocation policy and where we want to be from a long-term perspective in that case. So thought this was useful to add to the slide deck, and we'll update this as it becomes available. A lot of the data is very lagged given We have to get it from all the public funds. So.
I think it ties together nicely. Over my years here, you see the return versus peers quoted a lot in publications or anything else on it. And the return side means nothing without the risk side on it. So I think, capturing both sides of that really gives you a better picture of where things go.
So Chris, do you have the actuarial rate of return for these states as well? That would probably be.
Yeah, I mean, at 6.5%, we are on the lower side still. A lot of these plans have been lowering them. I don't know if we have all 50 states. Again, it's, but I'm sure we can get a good amount of those. But I think the average is somewhere around 7-ish or so now for the states. Was that?
They have come down a lot. Though.
Yeah, they have. I mean, we were at 7.25. Shortly after the treasurer started, he lowered it. I was able to lower it with the board's approval, and a lot of our peers at that point were 7.75 or 8%. So it has come down, and we've talked about this before when we've done our asset allocations, our capital market assumptions, and how much lower we think those are. So having a lower target is obviously beneficial in terms of just the fundedness of the plan, right? You have a lower target. It forces the General Assembly to fund more appropriately, right?
Right.
Assuming they will, which again, one of the biggest keys is, I don't know how many states have the support of the General Assembly that we have, but the fact that they funded that pretty much every year, you see a lot of these plans that are much less funded, that doesn't happen. It doesn't happen as much, or it doesn't happen every year. And if you stop that funding, it doesn't matter too much what you do on the investment side if you don't have that other piece, right? I mean, you realize that, which forces plans to actually take a lot of risk to make up for that on the investment side. So, I mean, it's there's a lot of pieces to it, but I think that's one of the keys is that having that support and being able to have an appropriate actuarial rate of return, it really helps with just the health of the plan as a whole.
It would be interesting to see what Wisconsin and Nebraska, those states that are higher than us, what their returns are.
Tennessee.
Yeah, I'll tell you,
Tennessee.
we've interacted over the years in NASIP with a lot of the states, and I will tell you generally, I have a high opinion of staff and what they do in a lot of those states that are on the high end. I can say that the ones that we know of, a lot of them on the list are well run. So it represents what we see on our side too. Like staff properly and run properly, those are reflected in that data up there.
I would add, and actually direct staff, especially for those that have a higher funding ratio, give John and the rest of us the insight of what their assumed rate of return is, because I believe I'm the first one in nearly 50 years to ever adjust the assumed rate of return. And we did that 4 times in 2 years. And we had to do it in partnership with the League of Municipalities, the County Commissioner Association, and the General Assembly, who were the funders of the plan. And I would just editorialize from an economic development standpoint, that no one has ever really digested this the way that I've tried to get them to over the last 10 years. Whether you look at the debt levels of the state of North Carolina or their pension funding, any company who's thinking about expanding or relocating to any of these other states like South Carolina, Alabama, they need to know eventually if they're going to relocate or expand in that state, they're going to be asked to pay that bill.
Right.
And even as Assistant Secretary of Commerce under the McCrory administration, I was unable to get anybody at the Department of Commerce to focus on that. It's going to happen. And if they're there and they've got their footprint there, they're building their plant there, eventually they're going to be asked to pay this bill. So just another reason that North Carolina is so strong. But we'll get you the statistics about specifically the ones that have a higher funding ratio than we do, what their assumed rate of return is.
Yeah, we can find it.
Thank you.
All right, moving on. Slide 22 is our liquidity profile. Left left side of the slide shows the liquidity allocation in terms of dollars, and the right side shows it as percentages. The blue bars is the most liquid level one, what we call level one liquidity, which is the most liquid assets, and then the yellow is the least liquid or pretty illiquid assets. By policy, we try to have at least 70% in level one liquidity for the total portfolio, and right now we're sitting at about 75%. So we're well above kind of our policy threshold there. The next slide is one you're familiar with, showing net benefit payments out of the portfolio by calendar year. You can see that's come down slightly in the last couple of years, but I guess what's more important to me is kind of that solid orange line there continues to decrease, and that's a function of the net amount going out as well as the increase in assets, right? So that's the percentage of money we send out of the portfolio versus the market value of the plan. Right? So, if that's below 3%, that's pretty healthy. And right now it's really just below 2% at the moment. So, that's something, we're obviously mindful. If that spikes or if that continues to go up and it's a much higher percentage of the total market value of the plan, then it's a much bigger liquidity constraint for us trying to manage it, right? Managing 1.5%, 2% of the plan, leaving the portfolio every year, that's certainly pretty manageable, and but it's something we certainly take a look at pretty closely and maintain kind of our liquidity profile to take a look at that.
Christopher, these will be easy for you. Does this reflect the 4% bonus that we just paid out?
It does. That should be in the blue bar, because I believe these are through blue bar should be through October's payment, which included that, I think.
We appreciate that appropriation at the General Assembly, but did they fund all of it the day we paid it out?
The General Assembly, no. I think that gets paid back over time, from my understanding.
So we paid it all out in one day, but they're putting us on they're factoring it. They're factoring their accounts payable to us.
You put the General Assembly on an easy payment plan?
Not voluntarily. And furthermore, I think this committee should understand something I've said repeatedly, and Lars foresaw this 35 years ago. The reason this chart matters is that there are less people paying into these pension plans than are not. There are less people paying into these pension plans than are not, and that matters. And
also continue.
Sorry?
That's going to continue.
And secondly, with this announcement that I'll talk about in the closing remarks about UNC Healthcare and EC physicians trying to divorce themselves from our pension plan after being married to us for over 50 years, but not take their liability with them, which is $500 million on the pension, $1 billion on the state health plan. So when you have less people paying in the plan than are not, and then you have one member of the family who wants to divorce and leave their bill for everyone else to pay, that's why this chart is going to matter more and more going forward. Thank you. Any questions about that?
Makes sense.
Yeah, okay.
Slide 24 shows kind of the liquidity profile of our alternative investments. If you take a look at the top right there, you can see the net cash flows from these asset classes over the last 12 months is a positive $257 million. So we are still cash flow positive from these more illiquid asset classes. We've seen that net number come down fairly significantly over the last couple of years. As we've seen, really this year, we've seen less distributions coming in on the whole, and we've had more money going out into new investments as some of our newer commitments are drawn down, as they've seen more opportunities. But we are still cash flow positive. It's getting closer to neutral, but we are still getting more in than we're sending out. And then the last slide I'll hit is just kind of the valuation lag profile. So this really just shows how our portfolio is valued in terms of timeliness. About 75% of our portfolio, which is really all the blue up there, is valued on a daily basis. That's most of the public market securities that are marked daily. We have about 9% of the portfolio that is marked monthly, some on a monthly lag, some in real time. Those are mostly kind of the hedge fund type structures that we have. And then you have in all the yellow up there, the quarterly valuations, which is about 16% of the portfolio. So that's most of our closed-end illiquid assets, like our private equity, a lot of our real estate. Those are the funds that we get quarterly valuations from the managers for, but we typically get them, 45 to 60 days after quarter end. So you typically see a quarter lag valuation in those, but you can see that more than 80% of the portfolio as a whole is valued at least monthly. So I mean, it's not a significant amount that's lagged, but just wanted to make sure that that's understood. If there's no questions on anything I covered, I'll turn it back over to Jeff.
Okay. Move on to slide 26. Take a look at the asset class performance, net of fees. Looking down the 1-year column there, the obvious strengths there in public equity, inflation sensitive, again, with the inflation that we've seen. Great to see that. And multi-strat as well. On the weaker side, real estate had a rough 1 year, as well as fixed income was weaker as well too. And private equity as well. We've talked about the timing issues that come in looking at private and public, and you see over longer periods of time where the value add is on the private side. So not a story that's too different than we saw last time. Moving on to slide 27, really this, just timing-wise, this covers most of the same periods, this calendar date versus the 1 year. So you still see public equity up top, on the far right on the top there, inflation as well, opportunistic fixed, doing well in multi-strat, and then obviously the weakness in IG fixed at the bottom, and the two real estate areas that we touched on the last slides. On slide 28, as far as new or incremental and commitments on the left side of the column, only really one item to report there on the core real estate side with Rockwood. That was a closing date in September. And then on the right side with unfunded, you can see where we're at total now of $7 billion of unfunded, and that's just slightly higher. I think we were at 6.9 maybe last quarter when we sat down. So no big changes there.
Jeff, the Rockwood was that was an additional investment.
We paid down some debt on some multifamily assets rather than roll the debt.
That's what I was thinking.
I agree.
I think it's important for the IAC members to know that in this environment where people are turning in their keys on real estate properties, they can't roll them, they can't refinance them, they're upside down. Part of this liquidity chart is the flexibility of having a sole fiduciary in the system we have here. When we see someone who's trying to, I use gouge in terms of prescription drug prices, but when we see someone who's trying to charge us an incredibly high interest rate on a loan on a property that we have equity in, we have the ability, with Troy's recommendation, his staff, to our team here to take them out and put more equity into the deal instead of paying 8, 7, 8, 9, 10% interest on these things. So I just think that is a creative way to manage a portfolio, is to have the ability, instead of paying these tremendously high interest rates, which would affect the value of this investment, be able to put more equity. Comment on that.
That's a good point, unless Troy has anything on it.
What kind of interest rates are your?
This particular loan is multifamily owners. We could have refinanced, no problem, but I think we avoided 7.3% interest rate, but we also avoided almost $1.5 million of loan origination fees. So it just felt better to pay ourselves at 7.3 and avoid that $1.5 million than pay it to somebody else. And if rates come back down, we can refinance later. We had plenty of equity in these. These were low levered assets, probably 40% LTV. So as the treasurer said, it's great to have that cash on hand and that flexibility. And we've got a couple more of these coming up in the next 6 months.
So it's not a one-off. but,
We're evaluating, every time we have an opportunity, we're evaluating it.
and do you know where specifically it makes most sense? I mean, if
Office, of course. I mean, if you've got a good office property, that's the next one you'll see next quarter. If you have a good office property, who knows where office rates could be? I mean, they could be 9, 10, 11%, just depends. This one particular one that was coming up, we had a floating rate loan on it, still term left on it, but it has a swap. It's fixed with a swap. The swap is actually in the money, so we can pay off the loan, monetize that in the value portion of the swap, and avoid paying almost, I think it's almost 8% for a very, very nice, well-located, 100% leased office property. Just choose to pay that off.
And
they
Ron,
have cash.
Ron, you're presenting today?
Yes, sir.
Okay, he'll give you some examples of things he's seeing that are 10%, 11%, 12%. And so he'll talk about that a little bit. And we have a good line of communication between what people are pitching Ron on what some of these interest rates are and what Troy's having to absorb. So it's them being able, their teams being able to talk to each other is very valuable to the whole investment portfolio.
Absolutely. Okay, on slide 29, which covers new and total unfunded, we're 6.26, right at 6%, I think, last time we sat down. Really just a reflection of asset value changes, and the similar number there on the yellow line on total uncalled. No real comments on 30 on the allocation history. And on 31, nothing new to report on exited investments since our last meeting. And then finally on slide
let me touch on 31.
Sure.
There was an article in Bloomberg Business and back in the early part of October that pointed out North Carolina had a high percentage of old funds. I'll just read the sentence. Old funds lock up pension money and time. And, this chart reflects a decision that we all made regarding selling some of our older funds at deep, deep discounts. 30, 40, 50, 60 cents on the dollar. When we didn't really need to. We have the flexibility to just let these things run their term. But when you go through the process of deciding whether to sell these funds, you also have to turn your hand over and look at the possibility of buying some of these funds. So some of the investments that we have made through Landmark and other of our managers put us in a position of actually buying these secondary funds that we know a lot about because we already own them at deep, deep discounts. So this article in Bloomberg Business was pointing this out. This was not a mistake. This is a strategic decision that we made not to sell things at deep discounts and actually look at the other side of the hand and see if we should be buying some of these things at deep discounts. So it's not something we have any issue with. So I just want to point that out to you. You want to say anything else about that?
I don't have anything. Suppose that's your world.
I think a lot of our peers, other state pensions, are having a little bit of a cash crunch, from what I'm reading, and they're going to probably approach the secondary market as sellers, and we'd love to be there to take advantage of what those discounts could be. And I think it's going to be a lot more supply than available cash to take it out, so therefore I think the prices might be lower.
In some of these instances, these are investments we already own that we know like the back of our hands. Okay, thank you.
Finally, the last slide on 32, which are our top 20 investment managers. There's no changes to the list from last time we sat down, and the numbers are similar on the total amount that we manage internally, right around at 54%, so still over half the assets that we manage internally at this time. That's it for the presentation. Somebody has any questions?
Any questions? CEM benchmarking.
Missing a wheel.
That won't be awkward. I really appreciate that.
Here you go. You can grab that.
Oh, great, thank you. Thanks.
You got a problem with our chairs?
This kind gentleman just said there's no wheel on the chair, and I would have gone
That's what happens when you watch the pennies of paper
something
clips.
ridiculous.
Missing a
I
wheel.
didn't say we watched the rollers.
Good morning, everyone. Morning. My name is Christopher Dahl. I am the Client Relationship Manager for CEM for North Carolina. I'm here to talk about cost, investment performance, and risk. The bulk of my presentation will be on costs, but I will do a quick overview of your investment performance for 2022 against peers. And we'll talk a little bit about risk, and I'll echo some of Chris's comments on how important the difference in your risk of your plan is versus peers, and we can see that in the results that you're achieving. So just by way of introduction to CEM, CEM exists to help plans do better for members. We're a fully independent third-party company that provides global benchmark reporting on cost, service, and performance to participating pension plans for over 30 years. We also provide peer-to-peer insights, data-driven research, and community and practices. As I mentioned, we'll review a very high-level review of performance, and the bulk of the presentation on the cost, and we'll happy to take questions as I walk through the presentation. I find it better to actually reference the slide, but when the slide's up there. But if you want a whole lot of questions, we can address them at the end as well. Nick, who's driving my slides?
Matt is over there.
So I'm just going to tell you. Is that good? Okay. Next slide.
Okay, can I jump in real quick just to remind? No, it's fine. Just want to. I know you all have seen this presentation more than once. Just trying to remind, as you're looking at specifically the individual categories, we go through this long process to map kind of our asset allocation and our categories to CEMs. They have a tall task of trying to make everything equal across all pension plans, all plans that they're comparing, and it's us trying to map our assets into their categories. So the categories you see won't necessarily be cleanly mapped to kind of our asset allocations. Just keep that in mind when you're looking at the specific categories. They may not map as cleanly as, private equity. There's several of our private equity assets that fit somewhere else, and some of our opportunistic fixed income assets fit in different categories, private equity type categories as well. So just keep that in mind as you're looking at the details.
What about expenses? How are they handled versus peers?
Well, so we try to be consistent with how, CEM can talk kind of the data management of that, but, we provide as much data as we have, which is pretty good data. And I think we've talked about this before. Some of the performance fees that CEM has is not compared across the peer group because a lot of the peers don't provide that, or don't have it, or just don't provide it. I'm not sure which, but so some of the comparisons exclude, and there's a section in there which show what's excluded and what's not. So it's apples to apples. They exclude stuff that they can't do apples to apples to try to get a good comparison across the peers. But I think overall, and we've gone through this many years now, we kind of understand the ins and outs of it in terms of, what's there, what's not, what we have to, understand is excluded, and just to get a good sense of kind of where we sit versus our peers. Again, it's just another tool we use to try to understand where maybe we're inefficient from a cost perspective, where we're doing a really good job, how beneficial it is to have internal management, that kind of stuff. So, that's really what we use it for. And it's obviously good to track, our total costs and see kind of what the peer has. So that's really the main reason we do it. And we present it every year now. So
I'll just build on his comment around some of the plans that where we are seeing differences or where there isn't data that's being reported consistently across all the plans. It really comes down to that private market assets, private equity, real estate, hedge funds, where that transparency and reporting performance
and carry isn't as clear. That has improved over the last number of years, especially amongst the larger plans, and we're getting more consistent reporting. I can see a time in the next couple of years where we'll be able to come to you and report comparisons with the inclusion of those performance fees on a peer-to-peer basis. So it is apples to apples. So we're getting there. It's a slow process as some of the managers drag their feet in reporting this to the plans, as I'm sure the team can attest. But I think that in time, there's enough pressure from the CEOs of major pension plans in U.S. and North America that the managers are feeling the need to start reporting in a more timely fashion. So we'll get there in time. Perfect. Good. Okay, so some key takeaways and highlights that we'll dig into as we walk through the presentation. So your 5-year net total return ending 2022 was 4.4%. This was above your policy return of 3.9%, which means your net value add was about 50 basis points over that period. On the cost side, your investment cost came in at 26.4 basis points. This was below your benchmark cost of 32.8 basis points, which suggests that you are lower cost. Based on our analysis, we determined that you're lower cost because you paid less for similar services. And the other thing I'll note on the cost side is your cost decreased by 8.6 basis points over the 5-year period ending 2022. Just to accentuate the point that Chris made earlier about your risk based on our calculation was around 9.6%. This was a 2 full percentage points below the U.S. public median, which is a really big number when you think about risk. So that has a significant impact on some of the return numbers that you're going to see throughout the report, and it speaks to your higher funded status. So all these things sort of tie in together, and hopefully that'll become apparent as we walk through the results. So those are the highlights. Next slide, please. So from our perspective, in building the analysis, we have over 265 funds in our universe. This comprises of funds from US, Canada, Europe, and other nations or other regions. The bulk of the peer universe is comprised of US funds, 146 in this analysis, with median assets of 8.7 billion and average assets of 29 billion. The total US universe is 4.3. So for the purposes of my presentation, though, I will be speaking to a peer group, which I'll discuss on the next slide, and the US public universe, which only includes 41 public-based plans that are reporting into our database. So when I talk about the US public universe, I'm referring to those 41 US public plans. And when I discuss peers, next slide, please, I will be speaking about these 14 public plans. So these plans have assets from 62 to 295 billion, and median plan size is around 112 billion, which is almost perfectly in line with your size at year end of 114 billion. This is good for comparisons. When we build peer groups, we try and find a peer group that allows the plan to fall in the middle of the pack so that we can get a good cross-section of costs and performance and differences in asset allocation mix to really get a representative analysis for your peer comparison. Next slide, please. So your plan 5-year net total return, as I mentioned, was 4.4%. Stronger performance in 2022 and 2018, along with. Sorry, my notes got mixed up here. Just 1 second, please. So stronger performance in 2022 and 2018 was slightly offset by weaker performance in 2021, 20 and 2019. But absolute performance doesn't tell the whole picture. So we compare your performance against your policy benchmark to get a better representation. And again, this comes back to my point, and I'll say this a few times through the presentation about risk. Because your risk profile looks so much different than your peer group, this comparison of your returns versus the peers is shortchanging your results because your risk profile is 2 percentage points different than the peers. So Your policy return was 3.9%. Again, this comes back to that risk discussion. It was below the peers because you are less risky than your peer group. So your peers were at 4.7. Sorry, U.S. Public was at 4.7, and the peers were at 4.9%. So that's quite a big difference. Differences are driven by a number of factors. So long-term capital market expectations, the liability status of the plans, and appetite for risk. Again, all things that we have discussed so far. And so when we look at, sorry, next slide, please. Oh, I skipped a slide. I'm sorry. So I just covered this slide, slide 6. Next slide again, please. Thank you. We're on this slide. I apologize. So the positive on this slide, we're looking at your policy mix average over the last 5 years compared to the U.S. public average. So on this slide, you had a positive impact from higher allocations to U.S. stock, which was the best performing asset class over the last 5 years. This was slightly offset by your higher allocation to fixed income, with some messaging that we heard earlier, which was the worst performing asset class over that period. I should also note that your policy return was all impacted by lower relative allocations to private market assets like real estate, private equity, and infrastructure, which were also high performing assets, just not the highest performing asset over that 5-year time period. Next slide, please. So your net value add, what the plan is actually contributing over your policy benchmark, and an indication of the strong performance of the plan, and was 50 basis points. This was driven by strong returns in 2022 and 2018, and positive net value add in 2020 and 2019, offset slightly by low net value add in 2021. I think it's important to note here that 50 basis points of net value add over a 5-year period is a great number. In looking at our historical database of 30 years, we've determined that 16 basis points on average is the net value add that plans have achieved historically. So your ability to produce 50 basis points over that 5-year period is well above the historical norm, so a good number overall. Even though it doesn't compare as well to your peers, you still generate that value add for your members, so a good story there. Next slide, please. So on this slide, we'll break the discussion down into 2 sections. On the top, it's your plan's 5-year returns by major asset class. You're seeing strong contributions from U.S. stock, real estate, natural resources, hedge funds, and private equity are all contributing to the net top line return of the plan. On the bottom side of this chart, we're looking at the net value add. So what is contributing net value to the portfolio? International stocks, fixed income, real estate, natural resources, but mostly that bar on the far right, that private equity portfolios over the last 5 years, contributing the most to your net value add during that period. Next slide, please. So that is my summary of the performance. I didn't want to dwell too much on that. We've got a recent update on Q3 performance, so this is already a little out of date. Where I'm going to spend the bulk of my time is on this section around the costs. So your investment costs, excluding private asset performance fees, which is what Chris was talking about at the outset of my presentation, do exclude those private asset performance fees because it isn't reported consistently across all of your peers. So to make the comparison apples to apples, we remove that out and just focus on the base fees that you're paying managers, performance fees on hedge funds, and other operating costs like oversight and custody. So your costs were $300 million, or 26.4 basis points in 2022. Of that, 26 basis points was investment costs, and about 3 basis points was oversight costs. There's some rounding error, so there's some rounding numbers in there. That's why it doesn't add to the 26.4. But for the purposes of this presentation, those are the results. Flipping forward to the next slide, please. So your cost trend, your cost decreased by 8.6 basis points over the 5-year period between 2018 and 2022, from 35 to 26.4. Year over year, and I'm on the chart on the bottom left, your plan cost decreased by 1.9 basis points. This was primarily driven by a reduction in your base fees. So I'm going to flip to the right side of the slide now, and we'll discuss what is contributing to that 8.6 basis points in change over the last 5 years. So you had a lower cost asset mix, which is driving the reduction in your investment costs over the 5-year period, specifically a reduction in allocations to high cost private market assets like real estate, infrastructure, natural resources, hedge funds, and private equity, which are summarized in the top portion of that table, where it says low-cost asset mix. This reduction in exposure to those high-cost assets resulted in 10.4 basis points in savings. Those were slightly offset by a higher cost implementation style of 0.6 basis points, and you paid more for similar services of about 1.1 basis points. And we'll dig into each of those as we go through the rest of the presentation. Next slide, please. So your investment costs, excluding performance fees, have declined consistently every year since 2016. On the left side of this chart, you can see that fees excluding the impact of performance fees have fallen from 50 basis points in 2016 to 26.4 basis points, so nearly 100% reduction. Or I guess a 50% reduction. On the right side, you can see the same chart, but we include the impact of performance fees where we have that information available for you and your peers. We're moving from 47 to 24.6 basis points. In both cases, the peer and universe averages have been stable or increasing over that period, and you've seen obviously significant decreases. I do want to pause at this point. 26 basis points for your investment costs is extremely low, and I would caveat that the ability to drive further cost savings from this point may become increasingly challenged. There are limits to how much you can cut costs, so I'll just caveat. I'll be impressed to see further reductions next year, but I wouldn't hold my breath on it, and I'll just leave that as a general challenge.
Mr. Kevin, that's a challenge.
No, that wasn't what I was suggesting. I just wanted to make sure the board isn't going to expect this trend line to continue to zero in perpetuity. That was more what I was getting at.
The next treasurer can improve on that, right?
Yes, right. That will be someone else's problem, right?
When did we switch over from to indexing? Was it 17, 18?
October of 17,
Yeah, I mean, that has
about a year ahead of time.
a fairly, I mean, in the overall cost savings here, it's somewhat muted. I mean, given that, I mean, there's certainly cost savings to doing that, but it's more of kind of changes to the assets, more of striving to be more aggressive with our managers to give us better terms. I think that drives a lot of it as well.
And the next couple of slides, I'll build on exactly where these, what's driving some of these savings and differences.
Am I thinking correctly that we're okay with higher performance fees because the underlying investment had higher performance?
Yes, that is, if you can have a low cost structure and pay high performance fees where they are generating performance.
So it's a good thing.
That is a good thing. If you have a low cost plan and you're paying performance fees where there's no performance, that's a problem, obviously, right? But I think that's the structure that you want. You want to pay for performance where it's being generated by your active managers, and you want to pay low base fees, which appears that this is what the team has structured here.
Wasn't that where we were looking at the fund of funds and the impact on our fund of funds?
Yeah.
High cost, low performance.
Yeah, and you're duplicating your performance fees, right? Because a fund of fund, you're paying, the fund aggregator is getting a performance fee, and then that is allocating to multiple funds underneath, which are also getting performance fees, right?
So that could be a nice chunk of this.
It could be. I'll dig into all this as we get through the presentation.
Yeah, and the fund of funds is, we've talked about this probably every year. I mean, it's always listed as higher cost because it is something we've de-emphasized significantly over the last decade or so, but we have some fund of funds that that are 12 years old, 15 years old that still have some assets in them that are still rolling off. So they still show up every year, and they slowly roll off, because unless we want to sell them in the secondary market at a discount, we still have them. So, it's something that high cost aspect of our portfolio has come down pretty significantly probably over the last 5-6 years, but we still have some of those assets that roll off as those investments finalize, and they distribute our capital back to us.
And I'll have specific numbers for you in a minute too. So that's your declining trend since 2016. Next slide, please. So your investment costs of 26.4 basis points were significantly lower than your peer median at 54.8 basis points, and against the U.S. public universe. I think it's important to highlight that you are in the bottom decile of fees, and against your peers, you are the lowest cost provider. Against the U.S. public universe, you're third out of those 41 plans in cost structure. Differences in costs are really driven by differences in asset mix and fund size, and both of these your plan is benefiting from both of these. So your lower allocation to high cost assets, you're at 23% versus your peers at 35%, is contributing to your lower cost status, and also your significant size. $110 billion is very large, and you're able to better manage the expenses in negotiating with your external partners. So you do get the benefit of that scale advantage. Having said all that, we still take your costs and we benchmark them against peers. So what we do is, next slide, please. What we do is we take your asset allocation mix and we compare that to the peer costs and what your peers are paying for similar similar investments and similar managers. When we do that, we can see that your costs are obviously 26.4 basis points, but your benchmark costs, when we do that cross calculation, your benchmark costs are 32.8 basis points, which means you're 6.4 basis points below your benchmark costs. And this is where we'll get into the attribution of what's driving that. Next slide, please. So you do have a slightly higher cost implementation style, but the bulk of your savings are really coming from paying less for similar services. So the 6.1 basis points of lower costs versus your peers, you had a higher implementation style because you used more external managers over lower cost internal. That was one reason. I'm just summarizing the top portion of this chart. You also had more expensive implementation of your private market investments, so greater use of LPs as a percentage of external. Even though your fund of funds are still rolling off, some have long terms, you have a greater use of fund of funds than your peers currently, but I know that's rolling down. And you use lower co-invest. So if you had to prioritize your investments into private market assets from a cost standpoint, fund of funds are the most expensive, LPs are second, and then co-invest would be the cheapest. And so in various forms, there's differences in how you've structured your plan and the history of how you've gotten to your investments in privates versus peers.
And just jump in here real quick. And these are things that we've been addressing over time. These things take a long time to play out. Specifically, kind of the more LPs as a percentage of external. We're trying to do more kind of separately managed accounts, stuff that we have a lot more control over. And then the less co-invests, we've really emphasized doing a lot of co-invests over the last several years as well. So we're emphasizing that now, and it just takes a long time for this stuff to turn over and to show cost savings, I guess, as opposed to.
Listening to what you're saying about the investment performance side of your presentation, it seems to me that there's very little to complain about. If someone was inclined to complain, what are your soft areas you say something's not right?
Well, I think they've already identified them, right? The move to better structured private market investments through the use of LPs and co-invest instead of fund of funds. right? And Chris is already working down that path. Again, it just takes time to turn the Titanic, right? There's not much, and that was, I guess, coming back to my comment earlier. You'd be hard pressed to get your fees below 26 basis points at this point, right? So
They might complain about that in 3 years.
yeah.
That's okay. All right, thank you.
Thanks. And so the lower, your higher cost implementation style was fully offset by your lower cost, by paying less for similar services. So you're paying external managers, you're saving 8.6 basis points versus peers on what you pay external managers. And when you factor in your internal investment management costs, that goes up to 9.8. So big savings in that area is really what's driving your costs lower than your peers, relatively speaking. So we'll break this down. Sorry, next slide, please. We'll break this down into the two segments. So your implementation style was 3.4 basis points higher. Couple of observations. I'm looking at the table on the bottom right. Your plan is 75% active. It's a combination of your private markets and public market investments. So you do tilt active, which is good. That helps you generate your net value add, and 25% positive. Your plan is nearly 50% internal, which results in higher implementation of 1.7 basis points, which is a little counterintuitive when you think of it, because it should be cheaper to run your investments internally than it is externally. I would say to this that this is an example of where you're reaching your limits of cost reduction, though. And we would expect normally that your internal management costs to be lower than external, but the differences in how and where you're implementing your internal management are affecting your cost savings versus peers on this specific number. So I just want to stress that there.
Yeah, so I guess for this one, a lot of our peers manage equities, active equities internally. We don't really do any of that yet. Where most of our internal is on the fixed income side.
Right.
And so paying for external equity managers is much more expensive than paying external fixed income, right? You can pay 10 basis points or so for external fixed income, whereas equities range from, 30 plus basis points, right? So that's where this becomes a negative number, which is counterintuitive, because you are looking versus how our peers are doing this versus how we're doing it, right? We have a good amount of internal versus our peers. It's just the differences in where that internal is. So we get a lot of savings from doing internal. So I want to make sure that's clear. It's just a comparison to kind of how the peers do it as well. If we were to be able to start managing equities actively internally and reduce some of our active equity managers, that would provide a tremendous amount of savings. But again, that's also a resourcing conversation and a talent conversation. Yeah, we are. And we've done. We've developed this internal core factor portfolio internally, which is somewhat active. And we're looking at that closer. But again, there's a lot more to take into account when you're developing an active equity program and fundamental analysis. And, you need probably a lot more staffing, a lot more, resourcing and all that. And
all industries.
Yeah, exactly. So there's a lot more to it than, running a passive portfolio. So.
Good. The only other thing I'd highlight on this slide in the bottom right, you see the three LPs, the three private market structures there: fund of funds, LPs, and co-invest, and you can compare where your rank against is your peers and the U.S. public. So on the fund of funds, you're at 1.2 versus your peers at 0.3, and fund and U.S. public at 1.5, and that's trending downward. We've noticed your peer group is a larger peer group, so they have moved like you away from fund of funds and into co-invests. So that same peer group has a much higher co-invest of 1.5 versus 1.1 for you, and then you use LPs to good effect at nearly 15% versus 12 for the peers and the public median. So, sorry, next slide, please. So that was your implementation style. This is your cost savings. So you're paying less for similar services than your peers. This slide is a really good slide. It's difficult to read on the page there, on the screen there, but on your page, you'll see that
It's also difficult to read.
well, I tried to make it as big as possible, but there's a lot of mandates going on in your strategy. So I will summarize at a high level. There's sort of three sections in here. So your external management program, your internal management program, and then your oversight costs. So your external management program, your lower costs in your public equities across all regions, so U.S., international, emerging markets, size-wise. Overall real estate and natural resource programs are also lower cost. Your hedge fund program, and more specifically the performance fees on that hedge fund program, were a big contributor to cost savings. You're also lower cost in your private equity and venture capital programs and your private credit program. So this external management program had cost savings of 8.6 basis points. On the internally managed side, you are saving, and this comes back to Chris's point a moment ago, your savings are really being driven on now on the top right side of the table. Your savings are really being driven by that U.S. active fixed income program, which is contributing about half a basis points in your savings. And then your oversight costs were also a very small 0.7 basis points. So total savings of 9.8 versus your peers on your investment costs and oversight costs. Next slide, please. So I like this slide. This slide illustrates how your costs would change if your internally managed assets were managed by someone externally. And so when we ran the analysis, we determined that your cost would be $30 million higher, or about 2.7 basis points. So you'd be about 10% higher than where you are currently if we took your internally managed assets and pushed them back out to external managers.
So we shouldn't do that.
No, I would propose that you're in the right direction, moving towards internalizing more of your investment management. And so next slide. So this is the cost effectiveness chart. This illustrates your ability to manage costs against your ability to generate value add. So the value add is on the left, and the cost is on the bottom. So your value add was 50 basis points over the 5-year period, and your average cost savings were 7.5 basis points over those 5-year periods. So you can see it puts you in the upper left-hand quadrant, which is high value add and lower cost, which is exactly where you want to be in this analysis. And without the influence of risk, generating good overall results. Some of the differences on those performance numbers will be driven by the risk that they're taking on in their portfolio. So I think the messaging that you need to take away from this slide is consistent value add, consistent cost savings, good news story overall.
How do you define global?
Sorry,
dots.
Sorry, where are you reading? Oh, sorry, yes. So global would be the 265 or 64 plans in our universe. So from that first slide, we had all the countries listed. There was 265 global peers. So that would be, you'd have the Canadians in there, you'd have the Europeans in there. So, okay, and then a discussion of risk. Sorry, next slide, please. So, and again, we talked about this already. I'm not going to dwell on this too much, but I will point out the fact that on the little table just beside the chart, you see that you're in the 5th percentile of risk amongst the U.S. public universe of 41 plans. Sorry, 5 percentile, not 5th percentile, 5 percentile. And so, as I mentioned, the lowest risk plan, one of the lowest risk plans in the universe, and it really drives a lot of the narrative around your results overall. So that's my presentation. Just to recap, your 5-year performance was 4.4 basis points. You had positive net value add of 50 basis points, and you were lower cost by 1.6 basis points. Overall, a fantastic story and good consistent management of the plan.
Are we still the lowest?
Sorry,
You're still the lowest.
lowest cost?
I think third.
Third to lowest. I'll clarify, lowest amongst your 14 peers, third amongst the 41 plans within our US public universe.
Lowest amongst our peers, which is.
All right, were we the lowest among the 41 at one point?
I don't know, I'd have to go back and look.
No.
So I've been mistaken.
No, because we were going against our peers. Because that peer group, we've been the lowest
Just
the last
say
couple
against
of
your
years.
peers.
So the lowest in North America is not accurate. Plans over 50 billion.
No, it's not.
It's not accurate.
Well, the U.S. plan is much lower assets too. That 41, that includes plans lower than the 20 billion. Our peer group is
About
It's
50.
26
so it was, our peer group is 61 billion to 300 billion. So
All right, so we're the lowest among our peer group in North America.
Yes.
We have a Swan investment portfolio.
A what?
A Swan investment portfolio.
Okay.
You know, that's sleep well at night.
Well, there seems to be high fives in order around the table.
Good job.
Any other questions?
The only round of applause you're going to get today.
I'm not looking for applause. I didn't do anything that did it. I'm just delivering the results. Thank you for your time.
thank you.
Thank you.
Lowest among our peers in North America.
Yes.
Yeah, in the US.
Yes.
I wouldn't say North America because I'm not sure where the Canadians go in.
All right. Okay. All right. And Robin, who just left, is the new chief financial officer, by the way. Sorry, I didn't get a chance to introduce her. All right.
Okay. I think we've got a investment grade fixed income review next on the agenda. So time to talk about some bonds. Y'all know Brett Hall, who's the director of and fixed income and long-term member of the team. In fact, he's in 25 years of service here at the end of the month. So safe to say all the numbers here we couldn't have done without him. But I'll let him touch on actually short-term first, and then we'll get into the core fixed income.
It's been a quick 25 years, so you know, feels like just yesterday. Lots of changes and always fun. So anyway, with that said, you guys have seen this chart before. This is our one-pager that we send out to quarterly to our STIF participants. As you'll recall, by policy, the STIF maturity range is 0 to 5 years. Currently, our average maturity is 0.7 years. So we're keeping things pretty short here. Looking at the first bar chart, top left, short-term rates are up dramatically. With these rising front-end rates that we've seen due to the Fed, we've been able to reinvest our proceeds into higher yields. The STIF rates have also increased over the last year. As of quarter end, we were at 4.1. A year ago, we were at 1.58. So it's a pretty dramatic change there, as you can see graphically. The STIF rate will continue to increase as we are able to reinvest proceeds into these higher front-end yields. So moving on to the chart to the right, you can see our STIF allocation. Assets are allocated across highly liquid securities. The focus is on preservation of capital. Just going through the chart here, our repurchase agreements. This is our portfolio's overnight cash vehicle. We're managing that to satisfy immediate cash needs. Currently at 1.1%. The type of repo that we do is the most conservative. We are taking treasuries and agencies as collateral, and it's delivery versus pay. The treasury piece of the portfolio is currently at 54%. And as you recall, we do front-end ladder treasuries out to a year. that provides additional liquidity to our participants in excess of the daily liquidity needs. Right now, we're putting $2 billion out each month to mature. We also have T-bills laddered out on the front end, about $1.5 billion, roughly $250 million each month maturing there. So the agency portion of the portfolio, as you'll recall, is predominantly callables. This is where we're investing excess cash, trying to pick up additional yield in excess of our current liquidity needs. This portion of the portfolio has grown a little bit as we've seen agency spreads widen out just a tad. Below, you'll see some of the portfolio characteristics for your review. Nothing extremely notable there. Next slide. On this chart, you'll see the stiff rate history. Just of note, the size of assets under management is currently $50 billion. I draw your attention to the red line is the stiff rate, and yellow line is the iMoney Net Composite Benchmark. Also, for your reference, we have some other comparable treasury rates. As you'll notice, going to the right of the chart here, that all front end rates are higher pretty dramatically here. So as you'll recall from past meetings, the stiff will outperform comparable rates in most periods, and that's due to the normally shaped positive yield curve. Currently, we have an inverted yield curve, so it makes going out very far kind of difficult to lock in that higher yield. And that's really the basis, that we invest, is basically looking at the ability to invest out the yield curve. We run a little bit longer maturity range than like your typical money market. The scenarios where we underperform are basically where front end rates rise rapidly. So as you'll notice, over the last 10 years, the red line has outpaced basically all other treasury rates in most periods. So we are currently a little bit lower. So as I mentioned, the current stiff rate as of quarter end was 4.1%. The iMoney Net was at 5.25%. You have 6-month T-bills at 5.5%, and the 1-year constant maturity treasury at 5.4%.
I think the couple of reminders here, the fact that yes, it is a cash vehicle for the plan that we're talking about here as well too, but also other various state entities, thus the $50 billion that's in AUM there, which is a far cry from where it was when we both first started working on the portfolio. And being the cash return basis, it does have that lag. So we definitely get some questions here as we have this rapid increase on the rate catch up, and we'd have meetings to say that long-term wise, it clearly shows that it adds value over time, but this is going to be the challenge environment. Frankly, one thing that's challenging now as well is the inversion Brett mentioned, because right now with the inversion, we can't even go out and lock up money at higher rates to hold down longer, which usually benefits us and carries us at a higher rate for a while. So hopefully we'll see that all that change in the near term, but still kind of rolling out. We still, because it's been so quick, we still have securities that are in the book that were in a low to zero rate environment world that we were in, and
yeah, still have a few of those. Just to kind of give you context, back in June, we kind of hit a peak with callables, and we're able to get a 570 coupon off a 2-year non-cost 6-month, about $300 million deal, but that was probably the largest coupon that we were able to generate there. So
turning on to slide 4.
Can I interrupt just a second?
Sure, go ahead.
I know we've had some redemptions out of the stiff recently. If people redeem out of the stiff, it's because somebody has talked them into getting 30, 40 basis points by just putting it in straight treasuries or something, or whatever they've been advised to do. So that the ability of people to do that still exists. You can get out of stiff and make a little bit more money in treasuries because of the lag of stiff.
They could, depending on the vehicle. Right now, yes.
Okay, the duration.
Yeah.
And then if they divorce out of stiff and then they want to get remarried again, can they just do that on a whim?
There's no restrictions that I'm aware of. As long as they're an eligible participant,
okay,
they can go back in the plan.
But they have to work within your workflow.
Yes. Yeah.
ability to
Which
buy.
typically, the nature of what we're buying here is very liquid, so that's usually not an issue. And we do ask participants to tell us notifications on large withdrawals, and why that matters is, even though it's treasuries and we could sell it right now for settlement today, we can manage it more effectively if we have a better feel for large money going in and out. And being able to manage it more effectively benefits everyone in getting a higher return long-term in the portfolio versus rolling the whole thing really short.
And if people make a request to liquidate out of STIF, is that subject to public record?
I don't know the answer.
So when you're referencing, are you saying individuals or municipalities?
Well, governmental entity, which could include all the above, in addition to hospitals and universities.
We'll move over onto slide 4 and we start chatting a little bit about the investment grade fixed income part of the plan. And I'll try and highlight a few changes in strategy. Sometimes year to year, we don't have really big changes in strategy, but in this case, we've got a few to talk about. On the top left here in the pie chart, I want to reminder, we talk about that blue part, that core fixed income a lot, and we'll talk about it today. That's kind of the long historical piece over time on it. And the red bar there is the cash. You know, for a while we were running kind of a 90 versus 10 core versus fixed. And then the newer piece there in the green is something that we brought up. We were just getting started last year when we sat and talked about fixed income. Was really a reaction to where rates were and where credit was as well too. Is we implemented a short credit strategy there. It's now 6% of the allocation, really as a standalone proxy for what we could do also in short term. So that book's right at $2 billion we put to work in the short credit market at real attractive yields. Really just gonna let it roll on in now and mature on in. It was all, generally 3 years and under paper. A lot of it shorter than the 2 year, 1 year phase on it. As a sign of how that's gone, because we started it late in last year, is that book since inception date's up about 3%, and you can see below what the rest of core has done as a whole. So it's been a real value add for us to this point on it, and feel really good about kind of how that worked out. So that's a newer item. On the right, another big change here is the relative weighting within the core part, the blue part of the pie there. If we looked at last year, we were underweight treasuries, like 3.5%, pretty material underweight, and a little bit higher on the mortgage side of things on it. As we've moved money back in, you heard Chris talk about what we pushed in over $2 billion back into core fixed income from cash. And we put a lot of that to work in the government sector as a whole. And because that was a real liquid place for us to go in and push the duration out, which is what we were seeking to do. And we'll talk some more about that. So you can see now we're like 1.5. So basically cut that underweight in half since last time we chatted there. On the return summary on the bottom left for all of IG fixed, you can see kind of where things were for the week quarter with rates headed higher. On the 1 year number, we're close to flat for last year. Really, the income was offset. There were the negative price returns that we saw from rates moving higher. And then we continue to see it outperform on all measured time periods for IG fixed versus our benchmark. So really the driving factor of the last year's was really the shorter duration. We've worked to narrow that as we put money back into work, but that really was a driving factor on that outperformance. On slide 5, taking a look at the core piece in particular, you can see the allocation I touched on up top. Again, on things that changed over time with the rate increase. So the last meeting we sat down, that yield to maturity was a 4.80. Now it's a 5.40 on that book. Rates going up. The duration was 7.5. We pushed it up to 8.1 now as a whole, and the maturity is extended out, as you might imagine, with us grabbing duration there as a whole. So all this kind of reflect the changes in strategy, especially over the last 6 months. Turning to slide 6 to look at the 10 and 30 year yield history, you can see them move up higher. Greg, you mentioned earlier kind of things changing here in the last couple of days with CPI print. This was one that we put this together back on October 24th. I can tell you that high mark there, where the number at 482, we printed the chart out. That's at 446 before we stepped down to the meeting today. So we've seen that kind of come back in as we saw some positive news on the CPI print here lately. But you can generally see the trend as we saw higher rates throughout the year which was definitely different than what the expectations are, and we'll touch on that here in a little bit too. Same story on the 30-year down below. That number is a 463 this morning versus a 499, I think, when we printed this out late October. As far as the shape of the yield curve, we'll turn to slide 7, and you can see here on the front end up top in the line chart reflects really the rate hikes that we saw, obviously, over the period. And generally, we're seeing versus when we sat down in the third quarter of last year, rates up basically 70, 80, 100 basis points, depending on where you pick on the curve on that. And again, we're roughly 30 beeps lower since this was generated back on the 24th. And then we also had a favorable PPI print this morning right before we came down as well, too. More news on that front. You can see it graphically in the bar chart at the bottom. So what was the consensus and forecast when we sat down last year? It was basically for rates to decline modestly, and instead we saw up 80 to 100 basis points on the curve. So safe to say the consensus was not correct. Turning to slide 8, which really captures our performance of the core portfolio by calendar year. I left this in here. We had this in here last year to talk about really how ugly the year was for fixed income with rates higher. Really what I'll call, like if we circle the bars on the top right, the last 3, kind of the great reset, I'll call it. And we've seen the year-to-date by calendar year September was down 2.4. We're actually closer to flat with what's happened since then as a whole. But it just points out over history here. And this goes back to when we went total return in June 97. So this captures all the way back of our mark-to-market performance. So really a rough time period for that. The good news is we've got this higher yields and higher expected returns, and we'll get into that. And the bottom chart captures our core relative performance in that book. And you heard CM talk about the cost savings of doing things internally. Well, that might not be any good if your performance is poor. So the other part of the equation is kind of how did you do versus your benchmark here. And this is a chart over time that not only Brett being here 25 years, most of our team has been here 20 plus years through most of this chart on it. So this chart is probably one of the things I'm most proud of for our team as a whole. I think we've consistently done a good job on that. Obviously, 22 was an outlier, and it was a phenomenal year. It was an uglier returns-wise, but we did the best we could within that market to kind of protect assets, I guess you'd say. But we feel like a good story over time, certainly, of doing it internally for the plan. I'll let Brett touch on spread markets a little bit.
Excellent. So this is basically our spread history for the credit markets. Draw your attention to the right side of the screen. Over last year, basically all corporate spreads have tightened, as you can see in the chart. Year to date through September 30, high yield tightened in about 140 basis points to 403. As of yesterday, that's 392. So continue to tighten even tighter. IG tightened in about 42 basis points to 125, and as of close of business yesterday was 123. In agencies, you did see a little bit of widening through the year there through September 30, but as of yesterday, basically flat over the year at 17 basis points there. So things continue to look good. So. Next chart. So this is a chart we've shown before. We do monitor relative value in corporates. What we're looking at on the top here, basically sector spread versus average rating per sector. As you'll recall, above the line is cheap, and below the line is considered rich, and on the line fair value. So the entire curve, as I mentioned, with tighter spreads, the entire curve has basically shifted lower. Notable changes here: banks, utilities, financial services, and energy. They continue to look cheap. In the sectors that have moved from what we would call fair value to rich are technology, retail, and services. And one sector that moved from cheap to rich was leisure. So on the bottom, you'll see, our long-term investment portfolio allocation by sector relative to our benchmark. The long-term portfolio is in blue and the index is in red. Our relative exposure by industry is fairly neutral. There are no overweights or underweights that are greater than 1%. Really no notable changes there, other than kind of a little bit of a drift there in banks from 15.9% to 14.4%, and in autos we went from 1.2 to 1.4. So that's basically when Ford was upgraded by S&P. We were able to purchase it, and so kind of get ahead of the benchmark weightings there. Picked up some exposure, so a little bit overweight there.
Yeah, I think that's a good point. Reflection of over time, one of the flexibility things that was changed in the statute, going back quite a ways, is investment grade by at least one. Used to be a long time ago all. And so given that flexibility to do that, if there's something that's on the way up, for reference to the autos, you're typically going to get a lift because when things go in to these composite benchmarks, even in fixed income, there's a buy for it to get neutral to the name. So we actually did this another time back during the auto crisis a while back, is kind of have on point there. We get that first upgrade, let's make a move. It's not going to go into the benchmark like it's one from the other agency because it's a composite rating, and just little things you can do to add value over time on that too. So it is something we monitor here as far as the exposure. So we're making active decisions on where to over underweight sectors. This kind of reflects the fact that we're kind of neutral right now to where spreads are, things are, and there's things we do within those sectors where maybe there's a certain name that our credit research, because we have a team of two that does all the work there and is assigned by industry group. So we have opinions within those sectors on maybe there's names we don't like or do like, and we'll reflect that in over underweights within that sector as well too, within credit. And then we're obviously making the active decisions on whether we're going to overweight corporates or mortgages, treasuries, or whatever the case is.
All right. Next slide.
Hey, we'll move over and talk about the FOMC projections, and it was always interesting. This is from the September meeting that was out there, and I like to go back and pull and look at the data from the last time we talked about fixed income, which was a year ago. And I'll try and walk you through a couple of things that are notable. I'll start in the bottom left where we have the Fed funds rate, and they have it listed out for 23, 24, 25. I will tell you, if we looked at this chart a year ago, these numbers are basically about 100 basis points higher than their projections that they put out at the September 22 meeting. Kind of goes along with what we see in the marketplace on it. And then a couple others. If we look in the middle, we have PCE inflation, and core PCE, which they love to look at that data set. I'll tell you those ranges, looking at 24, kind of right in the middle there, you can see that 2.1 to 3.5. That number was 2.0 to 3.0, so they've upped the range on what they think the inflation could be versus a year ago. Same thing in the 25 number. That number was 2.0 to 2.5, and they've included a range up to 2.9. So clearly shows over the year that they see inflation could be sustained a little bit longer than maybe a year ago. And same thing on the Fed funds rate on the bottom. Again, if we look at 24 and 25, that 4.4 to 6.1 number for next year on the projections from a year ago for 24 was 2.6 to 4.6. So that higher for longer mantra, it kind of shows in all the data and what they have. We'll get a fresh look at this coming up here in December. It'll be interesting to see where some of these numbers are. And then the other one that really stuck out to me was the longer run, which you always talk about at 2 to 3%, is in there on the Fed funds. That 2.4 to 3.8 now is 2.3 to 3.0. But they did keep the PCE 2.0 inflation number. They didn't change their long-term expectations of where that would be. So interesting times for them. With the data that we got from the CPI on it, we saw that the futures market, pretty much any chance of another hike disappeared in any numbers for next year. And we saw that the likelihood of a first cut kind of show up in that early summer time frame on it. I personally don't think we're going to get language at the December meeting that basically points to like, we're going to be monitoring things if we have to cut. I don't think they're going to show any sign of that at all. I think they're going to moderate the language a little bit, but I don't think they're going to show anything about that possibility. They're still focused on it. So slide 12, it just has the dot plots in graphical form on here. And this is basically every member's dot projection is represented by a yellow mark on the chart. Again, if we pulled and looked at the 24 date a year ago, that median number, which is the red line strikes through it, was below 4%. And the median for 2025 they had projected from a year ago would have basically been the second yellow dot from the bottom on the 25 label there. So again, big change in expectations from 12 months ago from the Fed. Moving on to slide 13. This is really, the data here is pulled out of Bloomberg here. Is we have a functionality called a bond yield forecast, which basically takes all the different firms and their expectations and gathers them all together in a composite rating, which just is the basis I'll usually use a lot of times for. This is the consensus at the end of the day on it. And we can see where rates were. So I guess we'll start off with Q4 23 and where things are for the end of the year here, expectations on it. And those numbers were basically 100 basis points lower last year. I talked about that on the earlier slide chart, so how off we were on that. And then looking forward to maybe next year, where we'll be for a year from now, you can see the data on there. And that same date a year ago was about 50 basis points higher too, so adjusted in that. So really, if you take a look at where we are market-wise now, focus on that really shows us down, depending on where you look on the curve on it, 30, 40 basis points, 50 basis points, somewhere in that range on it, kind of a modest decline from here's the consensus. Bottom chart is just the break-even rate on tips, kind of a basis for where expectations are in the market for inflation. You can see that basically all the Fed's talk about being diligent and not stopping on the rate increases to ward off inflation the market's believed them, I guess would be the best way to say it, because we haven't seen that number pop up at all in the 5-year break-even number. Moving on to slide 14. I think the top chart I had in a table form last year, but just kind of a good reminder graphically that we really, this portfolio in the investment grade market, your yield to maturity really is a good basis for your expected return going forward for 5 to 10 years. And what this chart has is the yield on those dates, and then the orange is the realized return the next 10 years from that date. And you can see kind of how well it tracks along there, something we showed last year, but a good reminder on that. And the reason I bring that up is the bottom chart is the yield for, this is using our core benchmark here as a basis. And you can see as the rates have moved higher on that, where we are, you can look at that chart a year ago and if we carved off 23, it looked attractive then. With the rate increase, it looks even more attractive. Pushing that 6% number, really a best time for expected returns in fixed income in 15 years. So I think this lines up what we said. It was a good time to put money back in the market. We may see some increases still from here a little bit, but we still feel like the entry point makes a ton of sense for the plan at these risk levels, at these returns that we haven't seen in quite a while.
Jeff, I think you said your average maturity was 12 years, or is it 8 years?
That was 8 years.
8 years.
8 on the duration side.
So
maturity date's like 12.
have you gone? Did you not go out any further?
We could.
You did, or
everything we've been putting in the $2 billion has been long. I'll tell you that. And I think the part we're really focused on, kind of near term, is within our fixed income portfolio. We've got that 90-10 split we used to have. Just some of that cash side now. We've been at like 80-some% highs for fixed income. Is really putting that money back into core as well too. So I see it as, still think it's attractive timing and intend to continue to look at moving more money back in to the market within this piece too, and taking on that duration now because we're getting paid for it finally at the end of the day on it. So.
I was just interested. I think it was probably maybe 2 to 2.5 weeks ago. Everybody hears 2, 10, 30s, but the 20s, that maturity was paying a great amount relative to everything else.
It's interesting times for that. And then one last chart, and then we'll take some more questions too if you have. So really, it's just on slide 15 is fixed income return expectations. And this is just a really simple simulation. It says, credit spreads remain the same. Let's just change the yield, treasury yield curve at the end of the day. And you can kind of see where we are. If we put the consensus was at 40 to 50 basis points, it would put us somewhere in that 7.5 to 9.5% for 1 year. Again, we don't really think about the portfolio in terms of 1 year when we're managing it, but I think probably one of the bigger takeaways, if we look at this chart, if you pulled up the last meetings we did on fixed from 22 and 21, there'd be very little orange bar in there because there was no coupon income. And now we're back in that environment where we have that. It's really a buffer to some rate increases. You can see even at up 50, you're still looking at a positive return over that time, assuming credit spreads move the same. Ironically, the one we did a year ago, I mentioned it was, expectations were down 40 or 50. We didn't have up 100 on the chart for last year. So anyway, expectations are for rates to decline modestly. No real concern over inflation surging from the current levels. In fact, we're seeing it moderating, even with the latest data on that. And return expectations for the asset class, I would put now in that 5 to 7%, just due to the rate. You glad to take any questions on
Fred,
bonds?
just make sure I'm on thinking straight here. We didn't want to get excited when returns on fixed income were -10, just hypothetically. Likewise, we don't want to get excited when returns are a positive 10%, because all that's just a function of marking the value of the security to today's price. Whereas if you hold it to maturity, you're going to receive your full principal.
Yes, if whatever you buy a security at that yield to maturity is what you will earn held to maturity over time on it. Obviously, in this world is,
right.
Sorry?
Assuming reinvestment in the.
Yeah, yes, exactly. So the market and really high, all the fixed income markets are daily mark to market now on that rate on us. So we think about it in those terms on it as well too, is what the return profile is going to be, just like any asset over time, because we have to get a valuation struck for what the status of the plan is if you had to liquidate any securities or anything else on it. I would say as far as excitement level versus 2 or 3 years ago, yeah, I'm way more excited. I mean, yeah, you heard me talk pretty bearish on bonds for quite a while. And so I think it's a great thing for not only the asset class, but the plan as a whole. When your risk-free rate is higher, it flows into all the other asset classes as well too on it. So, that lower for longer thing we were in for a while, I think I might have said it back then, that's the worst case scenario. We stayed down. We stayed near zero. I mean, it penalized savers. The reset was a positive thing on it. Painful thing. I don't think anybody thought it would be the speed with which we saw everything occur. For sure was a surprise. But I think it puts us in a much better place now. When your lower risk assets, you can get a more attractive return than, it's not just about downside risk. Actually, there's a return involved in it.
Right.
At the end of the day.
Thank you.
Any other questions?
We knew it was going to happen. It was just going to happen at some point.
We'll turn it over to Robert and talk about opportunistic fix.
Good morning.
Morning.
It's always a pleasure to get an opportunity to recap the performance, portfolio reviews, and share with you how the current environment may impact our future decisions. And this year is no different. So really, really appreciate the opportunity to spend this time with you. And today I have a new team member. We're excited to have Ming Zhu join our team. Very experienced portfolio manager. Lucky to have him join, and he'll get an opportunity to share a little bit about the performance that we've experienced this past year. I'm going to start with two slides that you always see, and the reason we do this is so that we never forget the point and the role of the opportunistic fixed income portfolio in the broader context of the portfolio, which is, I think, the most important one is capital preservation of this slide, but it's to have attractive absolute returns, relative returns to our benchmark over the long term, provide diversification to the broader total plan, and I think, again, last but second to last is capital preservation. And I think we have achieved that since inception, and definitely over a longer period of time. Maybe there are year by years or shorter periods of time where the relative piece may be challenged, but I think over the long term, as we are long-term investors, this portfolio has been able to achieve that goal. Next slide, please. This slide shows how we break down our portfolio. We break it down into four major components: traditional fixed income. So in there we might have high yield, bank loans, then distressed credit. We're underweight that asset class. We've been that for a while. We'll talk about some of the things related to that asset class. Hedge funds, and then what we call special situations, things that arise over time where we want to take advantage of what's happening in the marketplace. And things on the right show the various instrument strategies that we use to execute. Now I'm going to hand it over to me.
Thank you, Ron. It's an honor to be here. It's an honor to join one of the best public pension funds in the U.S. And this is sort of my first rodeo of doing this, and I look forward to presenting good or better results to this board in the years to come. So next slide, please. This slide just shows the percentage of our strategy within the overall construct of the pension portfolio. Versus what we presented last year, there isn't really any change to where we are. So currently, the opportunistic fixed income portfolio is 6.5% of the overall pension portfolio. It's about 50 basis points below where we target at 7%, which implies that we have about 500 million additional capital we can allocate to reach our target in the next 12 months also. Next slide, please. This next slide just shows the evolution of the optimistic fixed income portfolio over time as a component of the overall pension portfolio. As you can see that once again hasn't changed much over the last year, and we relatively stayed stable as a percentage of the overall pension portfolio since 2015. And over the past year, the bottom of the slide shows that over the past year, we really haven't had any new managers. What we have done is the two fund has been liquidated and fully matured, and at the same time we added two separate management accounts with our existing portfolio managers. That's consistent with our overall objective of lowering our management fees with our external managers. Next slide, please. The next slide, next two slides is going to show the performance of our strategy. As you can see, in the 1 year, 3 year, 5 year, 7 year terms, and also show the strategy return since 2009. The 1 year performance is a bit quirky, shows a pretty big gap between our strategy versus our benchmark. But if you all remember from last year, where I was not here, but last year at the same time we showed a huge drawdown of the benchmark. Last year the benchmark is down similar magnitude, while our strategy is positive. That's just a quirk within the benchmark, because the benchmark has a significant amount of distress and high yield components to it, and which had a huge sell-off in the later part of last year, in line with the equity market. So if you look at the 3-year returns and 5-year returns and 7-year returns, the longer-term horizon, our strategy has been consistently adding values and outperforming our benchmark. The bottom of this slide that just shows calendar years performance of our strategy versus benchmark. As you can see, year to date, our strategy is still outperforming our benchmark. So the 1-year performance is just a quirk within the capital markets, how it was performing later part of last year. Next slide, please. This just further breaks down our subcomponent of our strategies versus the benchmark. Once again, you can see a very consistent message. We have been delivering value for the overall pension portfolio over a longer period of time. For the past year also, our sub-strategy all focused on secured senior loans and investment grade securities, which shows a lagging in terms of performance versus the benchmark, which is more focused on the speculative and the risk spectrum of the fixed income universe that we focused on. Next slide, please. In the next few slides, I'm going to show the characteristic of our portfolios. As you can see, by strategy, by liquidity, and by capital structure. As you can see, one of our main goal is for capital preservation and safety of our assets. So, in terms of capital structure, more than half of our portfolio holdings are in senior secure lending and senior bonds. It's high up in the capital stack, and by liquidity, we try to. Most of our asset that we invest in is highly illiquid, but we try to maintain a slight for liquidities. So we still have about 10% of our portfolio is in level 1, which means we can. These are assets we can liquid over a few days. And then by strategy-wise, the biggest component is our hedged fixed income portfolio, which is about 1/3 of our overall strategy. Next slide, please. And this shows the characteristic of a portfolio by sectors. The message we want to show here is basically diversification we had within our portfolio. The 21% showed as other asset class is basically the CLOs and derivatives and asset-backed securities our manager has invested in. It's very difficult because it's a portfolio of fixed income products. It's very difficult for them to separate into sectors. So this is labeled as others, but these are also very well diversified by the sectors. And within the next highest category is financials, which is 17% of the portfolio, but that's mostly non-bank financial assets, which is also very well diversified, between mortgages and other asset-backed securities. Next slide, please. So this just shows the 4 sandboxes we play in terms of instrument we invested in our strategies: private credit, structured credit, bonds, and loans. In more recent environment, the structured credit has showed a lot of opportunity. So Ron is going to touch upon that in the next slide. In the next few slides, our managers has been moving into more structured credit just because where capital markets has given that opportunity, and we also very much focused on loans, where most of the loans are having floating rates protections, and also has better covenant that we can impose on the borrowers in this current environment, which Ron is going to touch upon once again in the next few slides. Ron, I'll just turn it back to you.
All right, thank you, Ming. But again, to recap these 4 segments that we invest in, the current environment is very attractive for us to be a provider of credit to the marketplace. As we talked a little bit earlier around how the high cost to borrow may be for real estate borrowers. If you don't want to actually pay the high cost to borrow, you should actually be wanting to lend and be a supplier of credit to the high cost borrowers. And so what I really want you to take away from the next set of slides is that today's current environment is very attractive to be a provider of credit capital. And we'll talk about some of the conditions that create that environment for us, and then a few things that you can read at night if you're if you're restless.
That you're considering, or are they charges that are already implemented?
So most of our portfolio has been implemented with an exception of $500 million. We're $500 million shy of being at our target weight. However, things that we're able to do on the margin with the treasurer, we're able to, on the margin, when spreads widen out, we're able to allocate capital to some of the higher performing, higher yielding strategies, higher expected return.
Something like CLOs.
Where our managers may rotate into CLOs at different times, but what we focused on this past year is just taking advantage of what we call our traditional corporate credit, high yield and bank loans, where the non-derivative form, the cash form of those instruments had a high yield to maturity, expected yield to maturity closer to double digits. Did I hit on your question?
Yeah, you did, but under the structured credit, there would be a lot of different odd derivative type.
Yes, sir.
But then you go back to private credit. What would we be
doing there? Private credit is where our managers are no longer competing with banks, or they're no longer competing with the syndicated market, where they can originate directly with the corporate issuer, and they're able to structure a loan directly and speak for the entire capital structure or most of the capital structure.
Do you have them in your portfolio now?
Yes, sir. And that is providing. I'll talk to you about the returns for that, but right now our private credit managers are lending at a rate of SOFR plus 500 to SOFR plus 700, with SOFR being closer to 5%. That gets you close to a double-digit coupon. Now, you might have losses, or you may have volatility along the way, but your top line, without fees and without a lot of things, you're looking at double-digit expected returns in a private credit book, in which we have a meaningful exposure to private credit managers, where we have that in the SMA form, separately managed account form, where managers are able to ramp that up for us when it's attractive, and also stay very neutral when it's less attractive. But how we got here, I'll show you. This is the next slide.
Okay.
We got here because banks tightening their credit standards, their lending standards. And as you recall from the mini banking crisis that we had this year with Silicon Valley Bank, that's also creating a significant amount of deal flow for our managers. Several of our credit managers, and in partnership with the real estate team, several of the managers that we're evaluating are bidding on loan portfolios coming out of the Silicon Valley Bank. I think we know Silicon Valley Bank as a technology-focused bank, lending to tech firms and technology funds, but they also have a significant real estate portfolio. So we believe going forward that a significant amount of our managers will be bidding on assets coming out of Silicon Valley Bank and other banks that may be overexposed to real estate and other banking regulations that may require banks to either sell assets or put more capital on their balance sheets because of Tier 1 and other requirements that banks have to.
Willing to offload certain investment criteria that gives an opportunity to view it to your related teams.
Correct, especially if you're able to be very selective with the assets. I definitely think, real estate's not my expertise, but within real estate, there appears to be a divergence between office and industrial and several of the sub-segments within real estate. So if you're able to find a manager, find a partner who can be very specific about the asset they're either lending to or recapitalizing, there's a significant amount of opportunities. And we have a slide later to talk about that. But
one more question. I would imagine, given your overall risk profile as the system. It gives you the ability to go into riskier assets in this asset set.
I think it could enable us to do so because of our capabilities. However, the team generally tries to do the opposite. The team generally tries to go up the capital structure, and which i.e. means lower risk, when the opportunity set up the capital structure is still an attractive rate of return. To put it in context, I think this is probably where I'm more thinking than having the actual numbers. But I think the long-term equity rates of return are in the low 7s, high 8%, and that's a really attractive return over a long period of your time if you're able to achieve equity rates of return in that area. We're able to achieve senior parts of the capital structure, although you're taking some credit risk with the corporate borrowers. We're able to achieve equity rates of return in today's environment. So if you're able to hit an equity rate of return, although that may sound risky, but because you're in the part of the capital structure that's the least risky, and you're able to lend to borrowers they're enabling you to increase covenants, put covenants in place, and then you're able to lend to asset-backed or strip out certain assets from the corporate borrower that you feel very comfortable and can sleep safe at night. That's what you should be doing, and that's what we're trying to do and aiming to do. For instance, one of the managers, actually, I probably shouldn't talk about that.
I think I might add that just because, as shown on this slide, is there is a lack of capital in the market, so we don't really need to go to the risky profile to get the returns we wanted. So right now we are not actually looking to adding risk. We are actually reducing the risk that we can get exposed to capital structure, still get compensated for that, and that's what we are arguing this is the best time to actually allocate it to private credit, to leverage loans, to CLOs even, that actually the risk is lower than what we can get for the returns we are being compensated for currently.
I think the other way I'd put it is not just enough to fixed income, all our private market stuff, really all of the whole team. There's a focus on risk management and controlling risk that's in the DNA of our office, I think, over time. And I think you see it reflected in the continued focus on downside risk. What we do in all the areas, all the things we do are different areas, and the risk is a little different in the areas, but the way it's implemented in Ron and that they're talking about there, I think reflects kind of the core part of really who we are and our style and approach.
In particular, I think when people hear CLOs, they think risk. And so one of our managers this past year allocated a marginal amount of dollars to single A CLO exposure. So single A, it's investment grade. They're able to earn an 8% expected yield to maturity for that security that they invested in, or the group of securities they invested in. In addition, way these particular tranches are structured, the portfolio or the borrowers in that portfolio could experience close to a double-digit annualized default rate for the next 5 years before the piece that they invested in would have any impairments. And so we don't necessarily see a default rate or expected default rate environment where that would happen. If that did happen, where we would lose any money for investing in those particular securities they invested in, I promise you won't be worried about my asset class. There will be more problems in other.
Don't worry about that.
So basically, it's almost like a no-brainer to take advantage of high quality, low default rate, low expected defaults, and not lock away or store away a 7% rate of return.
And the portfolio is going to, your target is 7%.
Yes.
Of your assets, right?
Yeah.
So,
For that piece that we allocated they should be getting 7% or more. And I believe that for our asset class, when we started it years ago, I think over a credit cycle, we were just trying to earn 6 to 8%. Those numbers seem to be the same over a credit cycle. And if you can lock away and earn a 7, we should probably do that, especially if you're doing a very low risk on a relative basis. Next slide. These are great questions, by the way. Please keep them coming because you're helping me tell our story and why today's environment is really a good thing. I need to buy you lunch next time. And
Buying lunch this time.
that too.
So
They think the General Assembly, you pay now, you don't have to pay later.
So, Ron, does First Citizens have you on speed dial?
No, they don't have us on speed dial, but our managers are definitely involved in looking at their books. I think First Citizens did make a really strong acquisition at the beginning of the year. I think all accounts people are really excited about their participation in the transactions that they participated in.
Why would you, I didn't get the context of your question.
Well, they got Silicon Valley Bank.
Yeah.
For government guarantees.
Correct. They got a sweet deal, in theory.
Yeah, well, they're state chartered, not chair of the banking commission. So we approved that transaction. And since you brought it up, we recently bought $20 million worth of GO bonds back from the corpus of Silicon Valley Bank for 71 cents on the dollar. Harlan Bowles did a lot of things, but he never pulled that one off. Right, Loris? Right.
Effectively, that lowers your cost of financing.
Yeah. But I know it's $7 million. It doesn't sound like a lot of it's not a lot of profit, but it was a fun transaction to do.
Yeah.
And we're looking for more.
Yes, sir. So the next two slides show the option adjusted spread and the current yield to maturity across going back to 2001. We're currently near the long-term average, but that long-term average is skewed by the experience of the global financial crisis. And so if you were to remove the experience where credit spreads jumped out to 3,000 and higher during the global financial crisis, you'd actually see that today's elevated spread and today's elevated yield to maturity opportunity is reasonably attractive. The funny thing about this slide is we put these slides together with data for 9/30. Between 9/30 and today, spreads blew out another 70 basis points, and then they came right back on in probably this week just to probably match the 9/30 date, maybe a little bit tighter than the 9/30 date. So we've had a lot of volatility even just during the preparation of this particular slide deck, and we'll probably, our comments might have changed a little bit, but the number one thing that remains the same is that today's environment, whether or not it's 70, 80 basis points wider or at today's levels, I really do think the absolute yield to maturity and maybe not the absolute spread, but the absolute yield to maturity in our asset class does provide an attractive expected rate of return with managers who can avoid defaults and avoid credit losses and be very thoughtful. Next slide, next two slides. Skip this one. To underscore that point, this slide's this is the first time we've used this slide, but to underscore that point, we really want to show what 2 years ago the opportunity set looked like relative to today. The blue shows the opportunity 2 years ago, and I think our slide deck showed that 2 years ago how tight spreads were at that time. Over 80% of the market of the high yield index that we invest in created an expected yield to maturity sub 6%, over 80%. So wasn't really giving you a lot to work with at that particular time. And over 80% of the high yield index 2 years ago was trading above par. So you really had negative convexity. You really could only earn a coupon and have negative convexity at the end of at the call or et cetera. How that's flipped to today and last year and today is that it's almost reversed. A significant portion of the opportunity set, where our investable opportunity set, is offering north of a 6 to 8% return, even going as high as 10%, and even further. And this opportunity set is even further skewed if you look at the distressed index, or if you look at CCC rated securities in the high yield index. A significant amount of that opportunity set is trading below 80, where you can earn a high coupon and have positive convexity in the event that issuer were to be able to refinance their debt at maturity, et cetera, et cetera. So the opportunity set is really attractive, even if you miss the very perfect months overall. Over a long period of time, short period of time, today's opportunity is really attractive across all of the markets that we invest in. Next slide. This slide deck also underscores that. On the left-hand side, we have several risk-free securities: 2-year Treasury, 10-year Treasury, SOFR, all priced somewhere between 4.5% to a little north of 5% at 9/30. And then in the middle is where we look at more riskier assets, high yield index, the double B piece of the high yield index, where you see a major step up in expected yield to maturity, approaching 9, 7, 9%. And then even CCCs, that's the distress piece that we don't have a lot of. Again, we're underweight distress. The expected return for the CCC index and lower is 15%. Of course, you have a lot of credit losses potentially in that space, but this kind of shows that that across our credit spectrum, the attractiveness of the yield in that space. And we even put in there some CLO single A's at 7.4% and CLO triple B's at 9%. So those particular strategies, securities, some of them are constructed in a way where the underlying issuers in that portfolio could have cumulative defaults, annualized defaults, north of 10% a year for the next 5 years and still not be impaired. And then over to the right is more of our private credit originated portfolio, where we're looking at SOFR plus 500 and SOFR plus 700. As of 9/30, those returns were in the 10 to 12% rates of return. Next slide.
Sorry, where would MBS show up in here? Mortgage-backed securities.
You know, we have one in there, the CMBS triple B average. I think that average index, taking all triple B tranches that exist, and then they did the average spread for that. Actually, I just put the spread and not even the yield to maturity. The actual yield to maturity is actually higher. I mean, I only put the spread in for this. Is 14%. But again, there's a lot of dispersion because the performance of office versus the performance of industrial is meaningfully different because of the expected performance going forward for office is challenged relative to other areas. But the CMBS triple B average is 14%, and then triple B is still, you know, pretty reasonably lower risk tranche.
What are you guys looking at for mortgage rates in the next 6 months with the inventory of housing, this flux and transformation of that market? Where do you guys see mortgage-backed securities going?
That's a great question. You know, I think the Fed and they have more to do with it than we can handle. But I think if we continue to have a strong economy, we believe that rates will be here for a while. If we end up having a weak, higher for longer, yes, sir. And if we have a weaker economy or recession, and borrowers are unable to buy properties at these levels, then we believe rates will come down. I think we've seen a meaningful move from in mortgage rates over the last 2 weeks. I think the expected mortgage rate went from somewhere between 8% to 7.3% in the last 14 days. And that's just no movement by the Fed, but that's just the market participants changing what their required rates of return for 30-year mortgages needed to be. So I think there's some movement there. If you look at housing, I think sales are down, et cetera, et cetera. People are challenged. Everybody's complaining about the cost of debt for new mortgages, et cetera. Nobody who has a low rate mortgage ever wants to sell and move. So there's also creating some strange dynamics in the housing market. That's why you're seeing home builders really take advantage of this market, where they're bringing new supply to the marketplace rather than existing home sales where people are moving from one region to another.
Yeah. I was going to say, I think on the rate side of things on it is 100% dependent on not just Fed, because they're really controlling more the short end, anything else, but what economic data we get. We got favorable data on the rates coming down, and we saw rates come down, yields come down, and mortgage rates come down with it as a whole. I think some interesting factors on the demand side of things are, reading some data that said that the excess savings for U.S. consumers had been depleted below the levels at COVID for the lowest 80% of incomes. Gone. So I look at it as the buffer. On top 20% not affected as much on the two. So I think that's I think the fact that if we did have a hard landing, get a little recession proof, I think there could be more challenges to the housing market as far as the ability to pay and the ability to get the loans on it. We've seen tight labor markets, kept wages rising, unemployment benefits, unemployment rates are low. So I think it's definitely a strange time. I wouldn't say I think we're going to see mortgage rates move higher necessarily, but I think the pace of the decline would be highly dependent on what we see in the inflation data kind of going forward and perception of planning stuff on it. But I think there's a lot of dynamics at play there. One of which Ron talked on is that the people that when the rates change that quickly, you've got a large number of the base that's in a much lower rate loan that they cannot replace, and will materially impact their ability in what house they can buy to move and do something else on it. So I don't know how all that part plays out, but I think that's a direct reflection of how quickly things changed.
I would imagine tranches. I was trying to find that chart that had the tranches of mortgage-backed securities. I would imagine you're going to see some pretty outlandish moves to spread tranches.
Well, what may be different though is we had issues before with tranches of RMBS. You had evaluations of housing plummet too. You really haven't seen that yet because it's a different. There's not an oversupply because these have been built. So,
but there's oversupply now. It's headed in that direction.
Yeah.
Potential.
How that plays out. Sure.
We're also seeing a meaningful bump off of delinquencies, off the bottom for delinquencies and foreclosures coming out of the period of the pandemic, where you had a foreclosure moratorium that extended through last year. I mean,
there's a bunch of junk out there.
There's a bunch of things that are changing.
I'll build on what I said a while ago, Mike, is talking about the savings being depleted. We had a discussion in one of our senior staff meetings, I don't know, months ago. So we were reading some data that was about new mortgage originations, and the percentage of them that was, and I wish I could put the number, the percentage of them that were floating rate. And the first thing you read, I'm like, why in the world would you want to take on it was the ARM stuff on it?
ARMs, yeah.
And the higher rates, we were talking about different ways you would use it or whatever. And it ended up, because this came to it, basically, there was a lot of refi cash outs going on. Like the originate, you would think there would be much going on at all. And, if you were sitting in an older loan, what do you want to refi it for in an ARM at a higher rate than what you probably had? Unless you got equity, you got to cash out to be able to still support spending on it. So you should watch how that plays out. Careful. Yeah. All right.
That doesn't sound good.
Yeah. And then this is perfect segue to almost a perfect segue, but again, this is J.P. Morgan's expected historical and forward. Well, it doesn't show the forward looking on this one, but J.P. Morgan shows the historical default rates. Again, meaningful pickup off the bottom coming off of the COVID, but we definitely expect defaults to increase moving forward. But that still doesn't mean we're not currently paid a handsome rate of return for taking risks that we're supposed to take. Next slide. How long can businesses deal with higher rates? So this is the bigger question that a lot of corporate issuers need to answer. If you go back to January 2022, you see this particular slide shows that over half of corporate issuers had a coverage ratio more than 1.5 times. So that means they were able to service their debt pretty easily, pretty thoughtfully. You had excess buffer free cash flow in order to service your debt, so you weren't really worried about defaults going back to January 22. But pro forma, December 2023, people are looking and believing that at today's rates, where SOFR is at 5%, SOFR plus, the 400 or 500 spread that businesses had to pay in order to secure financing, less than 10% of businesses are at a coverage ratio of 1.5 times. Some are right at 30% is right at 1 times. So there's not a lot of excess free cash flow. So that's essentially, one could expect either defaults to come, one could expect distressed exchanges to come, one could expect kicking the can down the road, or one could expect that rates may need to lower in order for folks to refinance. But this also is what gives us the opportunity to be able to recapitalize capital structures and actually earn a nice rate of return and premiums in order to do that. Next slide. This slide is more food for thought. It's not necessarily our view one way or another, but just wanted to show the historical spreads in the CMBS market. This is the CMBS BBB option adjusted spread since 2004, and today, or as of 9:30, that spread was 900 basis points over. And so, is this a canary in the coal mine? Is this an opportunity, or is this something we need to be worried about moving forward? The defaults expected in office or different behaviors of corporations with regards to work from home views and things of that nature may signal or create more contagion, or is it an opportunity for those with long-term capital to be able to provide financing to thoughtful locations where the underlying building is 90, 100% leased, and you're able to earn a 9-10% plus expected rate of return, even on losses. Not sure which way it's going, but we thought this was a very interesting data point to show. And this is the triple B's piece. This is not, mezz loans. This is not further down the capital structure. This is right in the middle. Next slide. Potential headwinds, what global conflict, deteriorating economic environment, higher for longer interest rate environment are all things that could derail our strategy, portfolio strategy going forward, increasing default rates or default rates being materially higher than one would expect. And then the issues happening with commercial real estate, whether or not it's regional banks pulling out of the space or issues with office. Those are potential headwinds that could derail our strategy. But at the same time, everything that's a problem could also be an opportunity as we look at the next slide. Potential tailwinds for us, given that banks are not suppliers of liquidity or suppliers of credit in this market. That gives us an opportunity to originate loans with higher interest rates and improved covenants. And then we can also do that with our strong manager lineup that we have, one thing that's really interesting, did not know this at the time we were recruiting Ming. That's a bad thing on me, but Ming has had some experience with some of our credit managers in his previous role, and it's also refreshing to know that some of the managers in our credit lineup were part of some of his previous underwriting and actual deal execution. So it further bolsters the fact that we have, in my opinion, a best-in-class manager lineup. Could there be opportunities for improvement? Absolutely. It's always an opportunity to improve your manager lineup. But at the same time, it gives me a lot of comfort knowing that day one we have team members that are experienced in general, then also experienced in our space, and then thirdly, experience with the managers that we have in our portfolio. So that gives us a lot to be happy about. Finally, this last slide. This next year, we just want to make sure we're taking advantage of the elevated yield environment with best-in-class managers. Treasurer's been super supportive of that. Then we want to make sure that we maintain exposure to senior debt. I think last year we had floating rate debt, but who knows where things that benefited us in the past, floating rate debt benefited us in the past, whether or not that looks more like fixed. Are you happy with your underlying corporate borrowers fixing their capital or not? Who knows? But these are our priorities for the upcoming 12 months. And then this is our presentation to you guys. Any final questions? Thank you. Any final questions?
On the bank. You have to work hard not to go to the bank.
I think so. I think with Dodd-Frank and other regulations that occurred over the years, it's been trying to push risk away from banks and into the hands of individual investors and institutions. So,
Yeah, I think a lot of that's hit on your last point there, the dislocation. In fact, we saw early in COVID, those changes really created a lack of liquidity. And we saw we were able to fortunately take advantage of some of that, even in IG and in Ron's area too on it too. And I think that those things still remain in place when there's an event. We want to be up dry powder, be able to put it really quickly. Because like we saw last time, the Fed can end it quickly too.
they can.
But I think that's absolutely the right way to look at things, and we've been successful doing it at this point. But it'll occur again.
Yeah.
Other questions or comments?
Welcome, Ming. Glad you're here.
Thank you.
Good job. Welcome. Any other new employees need to be introduced?
Well, Chris Bird is, stand up Chris real quick. He joined us. He's the portfolio manager for the supplemental retirement plan. So, works mainly on the DC and 401k and 457 plans. So he's been here since July.
Sean was here at the last meeting. Yeah.
Any comments by board members? Lance, thank you for joining us. I thank all of you for driving in and being participants in this program. Just a couple of housekeeping items. The General Assembly appropriated 4% bonus supplement to retirees, and I know it's not within the purview of the IAC, but you need to know how your money that's being invested, how it's going out the door. And we were fully expected to have that money in people's pockets in the November retirement check, but based on the Herculean effort of the retirement system staff, we were able to get that out in October. So that bonus was paid out. So you always need to think about the operations side of all this, and just want to thank the staff for all they do to make us look good, and we'll continue to meet as scheduled. And do we have the meetings agenda the meeting dates for next year? February 28th.
Yeah, I believe they were sent out. If not, they will be.
Yeah, we received sent out.
Yeah, I'm pretty sure.
Yes, they're sent out and they're already posted to the website.
Thank you,
Okay.
Gail.
A voice from above.
February 28th is the next one.
I can't argue with that.
So anyway, with that, I'll entertain, unless there's something else anybody would like to add, I'll entertain a motion to adjourn.
So moved.
Second. Motion is second. Any further discussion? All right, hearing none, in honor of Dr. Linda Combs, clerk will call the roll.
Mr. Enrella?
Aye.
Mr. Brewer?
Aye.
Mr. Oakley?
Aye.
Treasurer Fall?
Yep. Aye. We're adjourned. Thank you all very much.
Thank you.
You.